Sit down. Today we're reviewing a collective performance by the largest and most politically connected group of financial intermediaries in the world. The American banking industry. Specifically, the part of it that has spent the last 18 months fighting a panicked, well-funded, very expensive lobbying war against a single financial innovation. The stablecoin. I want to be precise about who I mean. I am not reviewing your local community bank manager or your mortgage loan officer. They are doing a job. I am reviewing the trade associations, the CEOs, and the industry lobbyists who coordinate policy in Washington and write the letters that shape legislation. The people who actually run the rent-seeking machine, and what they are scared of is very specific. They are scared of a digital dollar that pays interest. A dollar-denominated, fully reserved, transparent, programmable, 24/7 instant settlement dollar issued by someone who is not a bank, yielding 4 to 8% while their own savings accounts pay 0.01. That is what they are fighting. That is the entire war. On January 14, 2026, the American Bankers Association delivered a letter to the United States Senate. It was signed by more than 3,200 bankers. 3,200. A number designed to look like a movement and read like a threat. The letter demanded that Congress close what they called, their phrase, the stablecoin interest loophole. The loophole in question is not a loophole. It is a dollar that earns yield. That is what they are asking Congress to ban. Not fraud, not theft, not illegal activity. A dollar that earns yield in the hands of a citizen outside of the banking system. A thing the economy used to call having a savings account that actually pays interest. Specimen number 2. Brian Moynihan, CEO of Bank of America. In 2026, he went on the record with a specific warning. Up to $6 trillion, he said, could leave traditional banks if stablecoin yields remain legal. 6 trillion. And he said it like it was a problem. Listen to the shape of that complaint. If depositors have a better option, they will take it. Yes, that is how markets work. That is the sound of your product losing. That is not a systemic risk.
That is a review.
Specimen number 3. The joint letter from the ABA and the State Bankers Associations delivered later, which warned that up to $6.6 trillion in deposits could be at risk. At risk of what? Of being moved to a better yielding, equally safe, equally dollar-denominated alternative. That is not at risk. That is at choice. The English language has been deployed in service of protecting a monopoly. Specimen number 4. The timing. This letter did not arrive in a vacuum. The banks did not send 3,000 signatures about the 2023 banking crisis. They did not send 3,000 signatures about the $8 trillion the Federal Reserve absorbed in mortgage-backed securities in 2020. They did not send 3,000 signatures about the 2008 bailouts. The industry mustered this level of coordinated outrage for exactly one thing, a product that threatens their margin. Specimen number 5. The framing. Every complaint is dressed in the language of consumer protection. Local lending will suffer. Credit availability will decline. The financial system will be destabilized. Notice who is never mentioned in those sentences. Notice who is never centered. The consumer. The consumer in this telling is an object that needs to be kept somewhere. Not a person who gets to choose where to keep their own money. Here is the receipt that should be playing under every banking industry letter about financial stability. In March 2023, three American banks failed in a single week: Silicon Valley Bank, Signature, and then First Republic. The largest bank failure since 2008. The Federal Deposit Insurance Corporation had to invoke a systemic risk exception. The Federal Reserve had to launch an emergency lending facility. The taxpayers ate billions of dollars in costs. The thing that broke was not a stablecoin. It was not a smart contract. It was a regulated bank supervised by the same agencies that are now warning you about the risks of crypto. And the solution, as usual, was for the state to step in and backstop the losses while the executives kept their jobs. The private sector's favorite version of capitalism: profits to the shareholders, losses to the public. And that is the actual track record you should be thinking about when a banker tells you that a transparent, fully reserved digital dollar is a systemic threat. The systemic threat historically has been them. Here is the autopsy. Traditional banking has had, for most of modern history, a very specific business model. They take deposits at a low interest rate. They lend those deposits at a higher interest rate. They pocket the difference. That difference is called net interest margin, and it is the entire engine of the industry. The engine only works if depositors have no better place to put their money. For 100 years, they did not. Checking accounts paid nothing because checking accounts were the best available option for most people. The bank did not have to compete with anyone. It just had to be there behind glass with a logo. A stablecoin that pays yield is the first product in decades that genuinely threatens this model. It is not a competing bank. It is a competing product from outside the industry entirely. It offers the same thing the bank offers: a dollar that sits there, but it pays you for holding it instead of extracting a margin from you. The banks can see what happens next, and they are not wrong. If this product is legal, deposits leave. Moynihan was not making a prediction. He was making a confession. The 3,200 signatures on the ABA letter are not 3,200 bankers worried about your savings. They are 3,200 bankers worried about their own margin. Please ban the thing that would force us to compete. That is what the letter says underneath the polite formatting. Here is what you take with you. When a well-organized industry begs its regulators to ban a product on the grounds that the product is destabilizing, the first thing to check is whether the product is destabilizing anything other than the industry's business model. In this case, the answer is clean. Stablecoins have not caused a systemic crisis. Stablecoins have not required a bailout. Stablecoins have not wiped out customer deposits the way Silicon Valley Bank did. The only thing stablecoins are destabilizing is the assumption that a dollar in a checking account should yield nothing while the bank earns a spread on it. That is not a crisis. That is a correction. It is the first real competition the American banking industry has faced in a generation, and they are responding exactly the way every incumbent monopoly responds when a better product arrives, not by improving, but by lobbying. The banks are asking the government to protect them from the competition. The government is listening. You should be paying attention, because the outcome of this argument, whichever way it lands, will tell you more about who the American financial system is really built to protect than any campaign speech ever will. This is not financial advice. This is experience. There is a difference.